For me, it is a tremendous honor to receive this award and share this evening with my old friends, Arminio Fraga and Celine Bonaparte, who represent the very best of Brazil. This is sort of a Brazil evening, I think, as I look around the audience here. I would like to thank so many of my friends and colleagues who have joined me this evening, and in some cases on very short notice. Noel Latif puts these things together in a very excellent way, but we don't always get a lot of time in advance. But he always brings off a very successful event, which makes Noel such a great head of this organization. As many of you know, this is a significant week for me. Not only do I have the privilege of receiving this very prestigious medal, but I'm also retiring as Senior Vice Chairman of Citibank and Citigroup and transitioning on a part-time basis to be a senior advisor to Citi and Vikram Pandit. I often say it's not how you come in, but how you leave. The past few years have been difficult for the financial services industry as a whole, as we all know. We at Citi feel that we have made substantial progress. We've turned the corner, and that the strategic plan outlined by Vikram is a correct one, and we are all behind it. To paraphrase the book of Ecclesiastes, there is a time for everything, and now is the time for me to step back from full-time activities at Citi, something I think some of you in the audience, including my daughter, never thought would happen. It's been a great run for me, and I've enjoyed it tremendously, and I leave with 53 years of wonderful memories. Over the course of my career, I've had the privilege of working with and mentoring some of the best and the brightest that the financial services industry has to offer, both within Citi and other institutions. And a number of you are here tonight. In 1957, when I first walked through the doors of the New York City Customs House, the old building downtown, which served as Citibank's headquarters, to work for George Moore, then Executive Vice President International, who later became Citi's chairman, I couldn't have imagined the wealth of life-changing experiences that lay ahead, and that I would ultimately be defined as an international banker. Soon after joining, I moved to Venezuela, where my daughter, who is here with me tonight, Liz, was born, ultimately spending almost 20 years in Latin America and the Caribbean. During those years, I worked for Walter Wriston, who was then Executive Vice President International and later became CEO and Chairman of Citibank. And I feel very fortunate that Walter and his family are represented here tonight by his brother-in-law, Bob Dineen. Over the years, I guess I've opened many of Citi's branches in Latin America, the Caribbean, the Middle East, Central and Eastern Europe, China, and South Africa. In the case of South Africa, with the help of Frank Thomas, who was our lead director at the time. And I think this helped to grow Citi's global network and pioneer us in new markets, something I'm very proud of. The world is a far different place than when I began my career. We have been through the oil shocks of the 1970s, the recessions of the 1980s and 90s, the end of the Cold War, and now what we call the Great Recession, all of which have fundamentally changed the dynamics of global finance. And it is clear that further changes will come. Important actions taken by leading central banks combined with stimulus fiscal policies by many governments over the last 18 months served to stabilize global economic conditions and promote the recovery that now we are seeing. But there's still much to be done globally And despite the cooperative spirit displayed at the various G20 meetings, some actions taken in recent months are not consistent with the rhetoric of the G20 meetings, much less their closing statements. I'd like to touch on 4 points in particular. First, there is still an urgent need to address increasingly protectionist measures and countermeasures. Recall that during the 1930s, fear spawned the beggar thy neighbor, trade protectionist approaches, which only served to cement in what we now call the Great Depression. Beyond trade protectionism, there are the risks associated with financial isolation and financial fragmentation. We have seen measures taken by national or regional authorities to strengthen the so-called home bias or to insulate pools of liquidity for use by the domestic economy. We call it ring fencing. All of which have negative effects on global financial intermediation and regulatory consistency. The ongoing G20 efforts must include concrete measures to reverse this dynamic. Second, restoration of trade levels must be a priority. Urgent and concrete action is needed to include a number of pending trade agreements. Globally, I'm thinking of the so-called Doha Development Round, as well as a number of bilateral trade agreements that are underway. For the United States, these include agreements with Korea, Colombia, and Panama. Ongoing levels of high unemployment continue to feed the pressures for trade and financial protectionism, and in some cases, isolationism. The G20 must move beyond the rhetoric in order to roll back the damaging measures that have been put into place in some countries in recent months. These measures must not be the legacy of the Great Recession as they were the legacy of the Great Depression of the 1930s. And I say that in front of this audience because that's one of the founding rules of the Foreign Policy Association. When the Foreign Policy Association was founded, one of the things it always stood for were open markets, trade, and against protectionism. Third, there remains the urgent need to achieve convergence of international accounting standards and regulatory norms in order to ensure what we call a level playing field, as well as to prevent regulatory and accounting arbitrage, which helped get us into the Great Recession. And I think if we do not do something about it, we will be solely adding to the possibility of another one some years hence. We need sound and smart regulation that is implemented on a continual basis to ensure that risks are managed appropriately, yet innovation is not stifled. Strong leadership is needed to provide direction to the financial regulatory setting authorities to ensure internationally coordinated reform decisions. As you know, these measures are in front of not only our Congress, but in front of the major countries, both developed and developing in the world. Moreover, there needs to be an assessment of both the benefits and the cost of reforms before final reform decisions are taken. I think it's very important that we think a little bit, and the regulators, policymakers, members of Parliament and Congress think about what the effects of these measures are going to be on the future. Fourth, careful thought must be given to how the major economies of the world will unwind the massive stimulus packages and central bank liquidity programs that are now in place throughout the world, both in the developed and the developing countries. The maintenance of massive levels of public spending to boost the economy while adding additional central bank liquidity are policy decisions, I think, long-term, not short-term because they were necessary short-term, ill-suited to the creation of durable, non-inflationary global growth. I would ask us all to remember the lessons of the 1970s, where continued macroeconomic policy accommodation in the face of sharply strengthening domestic demand and intensifying price pressures eventually led to runaway inflation in the United States. Ultimately, Paul Volcker was called in to slay the dragon of inflation, and this drove rates up to over 20%, and some people think was one of the bases of the LDC debt crisis of the 1980s. But lest we begin the unwinding process too quickly, and this is very important, this is why there has to be a balance here, we must also remember the lessons of 1937 in the United States, which taught that prematurely pulling back fiscal and monetary stimulus will only serve to push the economy again back into crisis, to a double-dip Great Recession. So this particular moment in time for regulatory reform and for unwinding the stimulus is probably one of the most important decisions that policymakers have taken in the last 50 to 70 years. I will conclude my remarks by again expressing my appreciation to Noel Latif and the board of this great association for this prestigious award. Thank you very much.
Bill, congratulations and thank you for those great remarks. We look forward to many years of your counsel at the FPA. And now it's my pleasure to turn the floor over to Brian O'Neill, Vice Chairman of Lazar, who will formally introduce Arminio Fraga and present him with the Foreign Policy Association Medal. Brian?
Thank you, Noel. You didn't tell me that it was going to be this tough to follow Terry, Frank, and especially Bill, but fortunately we have another outstanding honoree. It's my honor to introduce Arminio Fraga, the founder and principal of Gavia Investimentos, current chairman of the BM&F BOVESPA Board of Directors, and former president of the Banco Central of Brazil, to whom the Foreign Policy Association presents its Foreign Policy Medal. Arminio is a distinguished scholar with hands-on experience in capital markets and an extensive career on Wall Street. In between his two tenures at the central bank, he worked with George Soros as a managing director in the Soros Fund in charge of the firm's emerging markets portfolio. Earlier in his career, he worked at Salomon Brothers, also specializing in emerging markets. Today, Arminio is the founding partner of Gavia Investimentos, Brazil's largest independent investment management company. He has taught throughout his career at universities, including the Catholic University of Rio de Janeiro, the Wharton School of the University of Pennsylvania, Princeton, and Columbia universities. He's also written numerous articles on international finance, macroeconomics, and monetary policy. He earns his PhD in economics from Princeton. Since 2001, he's been a member of the Group of 30. He is a member of the China Investment Corporation's International Advisory Board and a member of the Council on Foreign Relations. Shortly after Arminio's appointment by President Cardoso as president of the Central Bank of Brazil in 1999, the New York Times wrote that, quote, "He brings more than trading experience to this new post. While overseeing emerging markets for Soros, he also taught part-time at Columbia. Now back in Brazil, he has been credited as the driving force in restoring Brazil's credibility with foreign investors," end quote. Institutional Investor magazine was also lavish in its praise of Arminio. In an article that touched on his tenure at the central bank, Arminio was described as being part of Brazil's economic dream team. He was also called a superstar. In that same article, one emerging markets asset manager said of Arminio, quote, "He's a genius, and everybody knows that." Indeed, Arminio contributed significantly to the economic framework which is responsible for the success that Brazil currently enjoys. Two innovations spring to mind: a floating exchange rate and inflation targeting. The Foreign Policy Association is honored to present its medal to Arminio Fraga. Arminio Fraga.
Good evening. I'm very, very happy and honored to have been chosen for this this important award, and then to be here with so many friends, in particular with Bill and with Sueli. We've been out there for quite a while, and it's been a wonderful relationship, and it's just a delight to be here sharing this moment. I thank the board for choosing me. It's a strange feeling to be speaking, addressing a group such as this one in a moment like the one we're going through, and not talking about Brazil. But I won't. I hope you see it as a good sign. I certainly do. It is my general view that as we start to see recovery from this amazing crisis, it's just hard to imagine that we would ever go through this. And as a quick detour, I grew up in Brazil. I've been studying and investing and teaching about emerging and submerging markets all my life. I never thought we'd see the things we saw and we are still seeing in the more mature markets. And what I'd like to do is to talk about some macro and some financial issues that are still very much alive, despite of the fact that perhaps we're out of the intensive care unit. And I'd like to focus on two issues that I think are particularly important. They have to do with fiscal policy and long-term trends in fiscal policy, and also about some financial matters. And I do this. I hope I don't sound too negative, but I am somewhat concerned. And I think sometimes when you go through this sort of crazy crash that we've experienced all over the world, and then you kind of make it out through the amazing use of all the tools, to an extent also unimaginable in the past, I guess proportional to the crisis. Everything is big about this, but I think there's a tendency for people to sort of relax too much and to slack off and to think, okay, it's over, let's go back to the old ways. And I see that as a real danger and a serious mistake. It's almost like you're driving, you go on a long journey, and you have a flat tire, and you change that tire, but then you still have a long way to go, and it's really scary. Any of you if you ever experienced that? In a way, I feel a little bit like that about the world. We've had that spare tire now, used, and if we get another flat tire, it was not going to be very pleasant. So this bubble and the crash that followed it was gigantic, and so was the medicine that was applied. In many ways, what we see now as the response to the crisis is almost as if we were treating a bubble and the aftermath of the bubble with another bubble. in a way. You know, it's almost as if we got really drunk and then had that massive hangover and then, you know, had a beer for breakfast sort of thing. I'm not saying this is wrong. But, you know, it's a little strange. And what do I mean by that? You know, we have now, you know, zero or close to zero interest rates all over the place. We have this massive credit expansion by governments, either by their central banks or countries that have their own banks, like China or my own Brazil, pumping as if there was no tomorrow. And probably the most amazing of all, my view, is fiscal expansion. And to me, it means the problem hasn't been dealt with. We haven't really cured this. Some progress has been made, but rather some of, or actually lots of the problem has been moved around and is now sort of migrated to the balance sheet of governments. And so I'd like to address this issue of fiscal policy a little bit. I'll have some numbers. I hope that doesn't disturb your digestion too much. One thing we have to remember right off the bat is that fiscal policy around the world wasn't exactly sound as we went into this. We were already sort of running above reasonable debt to GDP levels, and many countries were running pretty substantial budget deficits. And many also face very important demographic trends, Japan being a good example, but not just Japan. The U.S., to some extent, has problems right now with the current debt-to-GDP ratio, and had already problems in the horizon, and not too distant horizon, related to Medicare and Social Security and so on. There are serious problems in Germany, in Spain, in Greece, and so on. There's a wonderful recent paper by the chief economist of the BIS that talks about this. The IMF also has a recent report that covers all this very well. Age-related government expenditure in the U.S., for instance, is supposed to increase by some 8 percentage points of GDP over the next couple decades. It's a lot of money. In Greece, believe it or not, that number, that increase is 12 points of GDP. And they're already up at 130% debt to GDP ratio and a double-digit budget deficit. So it's really a major challenge. Against this somewhat fragile backdrop, in order to deal with this crisis, budget deficits have been used as a tool, and there was a very reasonable fear of a sort of a second Great Depression. But budget deficits have gone up a lot. And here in the States, if you eliminate the cyclical factors, budget deficit went up from around 3% of GDP in 2007 to over around 9% if you factor in the below capacity situation we're in right now. So 9% of GDP or thereabouts is very high. The numbers for Japan are similar, but the debt to GDP ratio is approaching 200% on a gross basis, and on a net basis is also very high. And in the case of Japan, there's something that I hadn't noticed, but it really frightens me. I think I could use a little water. And that is that about half of the debt. Oh, good. Half of the debt in Japan is a very short maturity. About half of it comes due within a year. And again, in my experience in reading the history books, this is even making me choke. that much short-term debt is really scary. It almost doesn't matter what you do with the money. Doesn't matter. If your funding is short, watch out. So there's a lot of trouble. In Europe, we see, and we haven't seen in a long time, compliance with the Maastricht criteria. And it's not just the countries in the periphery, although those, I was talking about getting drunk, those certainly got drunk on the easy credit they got. It was great. They were just borrowing, you know, at 3%, 4%, whatever. It's just must have felt great. But, you know, it doesn't feel so good now. So Europe has its own issues, and for most countries, or many countries in the world, the fiscal adjustment that will be required as we exit this situation are going to be of the range of 5 to 10 points of GDP. This is big. I mean, for those of you who don't follow this stuff very closely. And you know, it's very tough to manage, and it's very scary. It is a byproduct of sort of the short-termism that we see in politics. And really, we have to ask a question: why is it that these societies, in many cases very mature societies, why is it they can't face this? This is a real long-term problem. And it's a failure. It's a failure of coordination. I think it's a failure of the global governance in many ways. The global institutions don't have the pull. There's a lot of things behind that. The Group of 20 is trying, but it is not an institution. It's just a group, and that has also no real teeth. So this is a problem. Is it impossible to deal with this? No, it isn't, but it is very hard, and so it's something I wanted to point out. There are some countries that have been doing a good job, not too many. A few come to mind. I don't mean to have a complete list here, but you see Norway, Chile, Singapore, I think probably Canada. So there is some hope. We in Latin America have been following developments in Chile and how they run their economies. Really, they've done a really, truly outstanding job. So we're trying to do the same. We in Brazil have our own long-term fiscal issues, and I'm hoping that we're going to be able to do something about that. So that was topic number one. The other issue I wanted to touch upon it has to do with monetary policy and financial policies in general. So far, inflation has been behaving pretty well, but given the fiscal vulnerabilities that I've just mentioned, we probably can't take for granted this could change possibly even at a moment's notice. But for now, it's something that is not really on the radar screen, and it isn't about that I want to talk to you about. Rather, I'd like to review another sort of characteristic of this world we live in, and that is this tendency for booms and busts that seems to be growing, not shrinking, as we move along. And what I mean by that is we live in a world where there is massive leverage. As I mentioned, a lot of it is short-term, and so you had the banking system, but also the so-called shadow or parallel banking system generating this gigantic amount of short-term debt. The whole thing is very complex, very opaque. And there are a lot of things that conspire for this to be the way it is. This is not an accident. By the way, I don't think this pattern of boom bust is an accident either. I think this is built into the system. And what's behind it is a number of things that are somewhat pro-cyclical, so they tend to step on the gas pedal when things are going well, and then when they should be going the other way, leaning against the wind, they do the opposite. And I mean here, risk systems, everyone using similar or identical systems, capital requirements being somewhat pro-cyclical, accounting standards, and so on and so forth. And we have a system where there's less diversity than we would like. You see herd behavior and a lot of instability. There's also, for me, a very bothersome asymmetry in the way monetary policy is conducted. A lot of central banks seem to be very happy to let things ride up and not do much about it, and then flood the market with liquidity when things go wrong, and it just doesn't feel right. This feeling that the central bank gives everyone a put is very bad. On top of that, you have deposit insurance, access to a lender of last resort, probably a culture of short-term kind of making the next bonus all over the place. So these are things that are going to have to change. And I also have the feeling right now that governments are willing to bail out pretty much anything. And that I find to be also not very healthy. I experienced this in my time in government when we were trying to turn things around in Brazil. We needed help. We got a lot of help. Bill was very involved in that process. So was Terry, who's here. But in the end, it is up to each country to do its part and to do well. And a policy of indiscriminate bailing out is not a good one. I'm very surprised right now, looking at the situation in Europe, as to see what their first reaction is. When I was on the other side of this discussion, they had this very tough attitude, of limits and no one should be bailed out and so on. And now you see this. Oh no, it's just 50% of GDP. It's another 50 billion. Let it go. And it's fine. It's like short term it works, but long term it doesn't. So I think some of these issues are being addressed, but many are not, I'm afraid, and it will take a long time. I don't think we're getting at the core of this, unfortunately, in the efforts that are going on. I don't have time to get into this today. You're probably ready to go home anyway. But this is a problem. So my view in a nutshell, just to try to conclude, is that sure we're living in an era of great progress where billions of people are being incorporated into the marketplace, and they're working hard, studying hard, working more efficiently, joining the market economy. All of that is great, but we don't seem to be happy with that. The world seems to want more, seems to want to run faster than it can, and has no tolerance for pain. And I think that it doesn't work. I'm leaving out concerns that I have with other matters, such as the environment, geopolitical issues, a tendency for nationalism that Bill mentioned, and so on. We could talk about that. I'm sure here at the Foreign Policy Association, these are issues that are discussed. But the fact of the matter is, I'm at the moment probably more concerned than the average person I meet. I wonder, if our leaders are going to step up to the plate and start addressing these issues. It is at the moment not likely, but hopefully I'm wrong. I'm actually more optimistic about the U.S. than many people. I think the U.S. will be able to turn things around. I'm also positive on China. I think China has shown great determination and also has shown the ability to pursue long-term goals. So don't go home so negative. But my basic message today here is somewhat negative. I appreciate you all being here and putting up with me so late in the evening. I'm happy that my family is here. My wife and my son are here with me today. Whatever I've been lucky to do so far. I've always had a safe harbor at home, and it's a good feeling. And I thank them, and I thank you all for being here tonight. Thank you.
Arminio, thank you for your insightful remarks. Ladies and gentlemen, we stand adjourned. Good night.